What if I told you that global markets don't just move because of numbers, they move because of emotions, fear, uncertainty, and sometimes just a small sense of relief? And right now, that exact shift just happened. Recently, Donald Trump shared an update about the United States and Iran. He described the talks as productive and confirmed that potential military action had been postponed. Now, at first, this might sound like just another political headline. But in reality, this kind of update can quietly influence how the entire financial world reacts. Because before this announcement, the global mood was very different. For days, tensions were rising. There were concerns about conflict, about escalation, about what might happen next in the Middle East. And when uncertainty increases, markets don't feel comfortable. Investors become cautious. Some start pulling money out, others stop making new moves, and many simply wait, watching, thinking, what's coming next? This is how fear slowly builds, not always through one big event, but through continuous uncertainty. And then something changes. Trump's statement introduced a different tone. He didn't say everything is solved, he didn't say risk is gone, but he said something important. Talks are happening, they are productive, and action has been delayed. Now, pause for a moment. Because in the world of markets, this is enough. Markets don't wait for perfect clarity, they react to signals. Even a small signal can shift expectations. And once expectations shift, behavior begins to change. Think about it like this: if investors believe things might get worse, they act defensively. But if they feel even slightly that things might stabilize, they start opening up again. And that's exactly what happened. The emotional tone shifted from fear to cautious relief. And that shift is powerful because markets are not machines, they are driven by people. People who feel pressure, people who react to headlines, people who make decisions based on perception. So when perception changes, everything starts moving. We saw signs of that movement almost immediately. Stock market surged, major indices jumped, confidence started to return. And at the same time, another important signal appeared. Oil prices dropped. Now, why does that matter? Because oil is deeply connected to global tension. When the world fears disruption, especially in regions like the Middle East, oil prices rise. But when those fears begin to ease, prices fall. And that's exactly what we saw. This wasn't just a random movement, it was a reaction. A reaction to the idea that maybe, just maybe, things are not getting worse right now. And sometimes that's all markets need. Not certainty, not guarantees, just a shift in expectation. But here's something very important to understand. This does not mean everything is stable. This does not mean risk has disappeared. It simply means the immediate fear has reduced. And markets respond very quickly to that kind of change. But they can also reverse just as fast. Because if talks fail, if tensions rise again, the same emotions will return. Fear will come back, confidence will drop, and markets will react again. That's the nature of today's financial world: fast, reactive, and deeply emotional. So, what really happened here? It wasn't just a political update, it wasn't just about one statement. It was about how that statement made